Let's get straight into some of your calls in the equity market. We looked at Dollar General in the last week, Dollar Tree in the last 24 hours, highlighting the pain the consumer's going through, job openings dropping back down to levels we haven't seen for a number of years. And yet, John, you want to buy cyclical areas of the economy. What's behind that call?
I think what it is, Jonathan, is where we are today is we are in the process of a normalization, moving towards sustainable growth at a pace where we don't grow inflation too hot, and yet we do not destroy the labor market. And I think that you don't want to get defensive now. It's wrong time, we would think. So we want to own cyclicals. We want to be broadly diversified to take advantage of what has been a much broader rally across the 10 sectors since mid-year. And at this point, we would say, if anything, that the JOLTS numbers, if you look at the JOLTS numbers and you go back, I put them on my Bloomberg, and I went back from July of 2009 to July of 2018, which was a real period of recovery, moving through that. Then the average JOLTS was 4,608, and people got bent out of shape with a 7,000 number yesterday. I don't get it.
John, other people do get it, and they're buying utilities, they're buying staples, they're buying real estate. Why is that the wrong place to be?
I don't think it's the wrong place to be. I think you want to own some of them. I just wouldn't be overweight utilities or staples. And the performance on a year-to-date basis, on a basis of from the lows of October 5th, and in the rally points that we see, all favor cyclicals in a very definite manner. It's where you see the earnings growth, although you do see there's been awfully good earnings growth in utilities within the S&P 500, but a lot of that is likely the result of regulators allowing utilities to charge more as their input costs have gone up significantly over the last few years.
As you mentioned, the cyclical play has actually gotten quite a bit of attention, has actually done better and outperformed over the past couple of months. What hasn't is NVIDIA, which is down 22% since June 18th, since that peak that it saw then. Why not just hoover up NVIDIA at a 22% discount?
Well, you've got to say, what is it? I think the other day I was just hearing it's up over 100% since the start of the year, even with that pullback. You've got to figure that what we're seeing now is broader diversification being selected by investors after we've seen these narrow periods, narrow leadership with the S&P 500. And as we're in a period where the Fed has stated it's very much concerned about the labor market and doesn't want to hurt jobs in here, you're going to get a rate cut coming up earlier than we'd expected. It looks like September's good for 25 bips. And we think there's good chances, as you mentioned at the beginning of this segment, we were thinking 25 in November, a potential, and another 25 cut in December. It's as needed, as it says on the prescription bottle. But no recession yet, and more people believing we're likely to skirt or avoid a recession. So we think you want to own cyclicals.
So that's exactly.
We also think once the Fed begins to cut, you'll see a more sustainable a rally potential from small and mid cap stocks, which have faded in and out during this period.